The economic relationship between the United States and China has become increasingly strained, particularly in terms of trade policies and financial strategies. The Trump administration has adopted a protectionist stance, aiming to bolster the U.S. economy and safeguard domestic industries. Central to this approach is the imposition of significant tariffs on Chinese imports, with the administration proposing a standard tariff of 10% to 20% on all Chinese goods, and even higher tariffs of up to 60% on certain Chinese products. In response, China has implemented 3 key countermeasures. One of these responses is export restrictions, which were introduced by China in January 2025. The Ministry of Commerce unveiled new measures that target technologies crucial for manufacturing battery components and processing essential minerals like lithium and gallium. These restrictions are part of China's broader strategy to strengthen its position in the global battery supply chain and control the processing of critical minerals. As of 2022, China controlled approximately 72% of the global lithium refining capacity, further consolidating its role in the industry through investments in lithium reserves in countries such as Chile, Canada, and Australia. These export curbs could create major challenges for Western lithium producers who rely on Chinese technology for chemical production, and they might also affect the global expansion plans of Chinese battery manufacturers like CATL and Eve Energy. Another major strategy from China involves pushing the international use of its currency, the renminbi, RMB, or yuan, as part of a broader agenda to reduce dependency on the US dollar and increase financial autonomy. Over the past decade, the share of the yuan in China's cross-border transactions has grown significantly. In 2010, the yuan accounted for less than 1% of China's global transactions, with the US dollar accounting for about 83%. By March 2023, however, the yuan surpassed the US dollar in China's cross-border transactions, capturing 48.4% of the share compared to the US dollar's 46.7%. By March 2024, the yuan's share reached 52.9%. This shift reflects China's concerted efforts to internationalize its currency, and these efforts have been accelerated by geopolitical tensions, such as sanctions on dollar-based transactions, especially after Russia's exclusion from the SWIFT network in 2023. This has led to a significant increase in trade between China and Russia, with more than 70% of the transactions now being settled in yuan. To facilitate the yuan's global usage, China has entered into currency swap agreements with over 40 countries, allowing trade to be settled in yuan rather than requiring the use of intermediary currencies like the US dollar. China has also established the Cross-Border Interbank Payment System, CIPS, as an alternative to the SWIFT network, enabling secure yuan-based international payments. These moves are aimed at positioning the yuan as a viable option for global trade, especially in regions where China has strong economic ties, such as the Middle East and parts of Africa. In line with this strategy, China has managed to establish yuan-based trade agreements with major oil-exporting countries like Saudi Arabia and the United Arab Emirates, allowing for oil sales to be settled in yuan rather than US dollars. This not only strengthens economic ties with these nations but also reduces the reliance on the dollar in global energy markets. Despite these advances, the yuan's global use remains limited compared to the US dollar, which continues to dominate international reserves and financial markets. By late 2024, the yuan made up about 3.5% of global reserves, while the US dollar accounted for 58%. Structural factors such as China's strict capital controls and limited transparency in its financial markets remain obstacles to further internationalizing the yuan. Parallel to these efforts, China has been systematically reducing its holdings of U.S. Treasury securities as part of its strategy to diversify its foreign exchange reserves and reduce exposure to U.S. dollar-denominated assets. Since early 2024, China has decreased its net holdings of U.S. Treasury securities by more than $21 billion. As of October 2024, China's holdings had fallen to $76.1 billion, the lowest level since February 2009, and a 42% decline from a peak of $1.32 trillion in 2013. This reduction is consistent with China's broader goals of diversifying its foreign exchange reserves, enhancing monetary policy independence, and reducing the risks associated with holding US dollar-denominated assets. China's decision to cut its U.S. Treasury holdings is influenced by several factors. First, diversification helps mitigate the risks of currency concentration and improves the safety and profitability of China's investments. Second, reducing reliance on US dollar assets gives China more flexibility in its monetary policy, allowing it to better manage its currency, the yuan, and maintain greater economic stability. Third, growing concerns about the sustainability of US debt have also played a role. The US public debt has surged, reaching over $33.4 trillion in 2023, fueling worries about the long-term stability of US Treasury securities. In a similar vein, Japan, traditionally one of the largest foreign holders of US Treasury securities, has also been reducing its holdings. Since 2020, Japan has cut its US Treasury holdings by over 21%, reflecting broader trends in both Japan and China of decreasing foreign investment in US debt. In the past 3 months alone, Japan has sold $61 billion in US Treasuries, while China has reduced its holdings by $51.3 billion. These large-scale sell-offs could have significant implications for the US economy and the global financial system. The reduction in foreign demand for US Treasury securities could lead to increased yields, which in turn would raise borrowing costs for the US government, businesses, and consumers. Higher borrowing costs could slow economic growth and create challenges for the US government in managing its budget deficits and financing various projects. Furthermore, a decline in foreign demand for US debt could weaken the US dollar, which would have both positive and negative consequences. On the one hand, a weaker dollar would make US exports more competitive, boosting the manufacturing sector. On the other hand, it would raise the cost of imports, contributing to inflationary pressures and potentially eroding consumer purchasing power. The broader geopolitical implications of these shifts are significant. Both Japan and China reducing their US Treasury holdings could strain their relationships with the United States, particularly as they move away from dollar-denominated assets. At the same time, these actions could disrupt global financial markets and force the US government to rethink its fiscal policies. In response to these shifts, the Trump administration, which has focused on an America First policy, could face challenges in managing US foreign relations and economic policies. The administration's protectionist trade policies, including the imposition of tariffs on Chinese imports, risk provoking retaliatory measures from trading partners such as Canada. This could lead to a trade war, further disrupting global trade flows and potentially harming US exporters. Such tensions could also complicate the administration's foreign policy objectives, as trade disputes with key allies and adversaries could escalate, affecting global economic stability. In conclusion, the evolving economic strategies of China and Japan, particularly in their decreasing investments in US Treasury securities, present significant challenges for the US economy and global financial markets. These shifts could lead to higher interest rates, a weaker dollar, and disruptions in international trade. The Trump administration's protectionist policies, combined with reduced foreign investment in US debt, could strain US fiscal policy and international relations, reshaping the global economic landscape in the years to come.